Welcome back to the CD Financial Podcast, where health meets wealth. I'm Marcus C., your host. That is Chuck D., the man with the plan, right across from me. Chuck, how you doing today?
Fantastic. Thank you, Marcus. How you doing?
Excellent. Trying to recover from all the rain we've had lately, but we're in good shape now. I see the sun shining, makes me happy.
CD Financial, where health meets wealth.
So I thought today we could talk a little bit about the TSP and the 5 funds. I know you've referenced that in other videos and had some more information, but I thought maybe we could go in a little more in-depth understanding the funds. For instance, what factors do we need to consider? Let's just start with that.
Sure, let's do it. So we've got 5 funds to pick from. It's first and foremost really important to understand the key ingredients to these 5 funds. You've got the G fund. Really, the G fund and the C fund are the 2 most used and most famous funds out of the 5. How do I know this? Because I've just looked at thousands of TSP statements over well past the 15 years I've been helping federal employees and their family members. So the G fund is a government treasury fund. So it's actually guaranteed against loss by the U.S. government. That's one thing that we can say. And then you've got, I should talk a little bit more about it though. Over the last 10 years, it's done about 2.4% in returns. Last 5 years, maybe into the 3 percentile. But the challenge of the G fund, the pro is that it can't lose money. But the challenge to the government fund or the G fund is that inflation can kind of whittle it away. Right? And then you've got another fund. The 3 original funds, according to any 401k, you need 3 funds.
All right.
And so they had
investing in that G fund, does that make me a G man?
It's funny, isn't it? It used to be an expression in the old movies, wasn't it? Yeah. So the F fund, so it was originally it was just the G, F, and the C fund. The F fund is fixed bond fund. And so a bond pays a fixed rate of interest, which is, believe me, oversimplified here when we're talking about the F fund, but that's why it's called the F fund. And then you've got the C fund. The C fund is the S&P 500 stock fund. So it's the, more or less we think of the largest 500 companies in the U.S. So we say domestic, right? So it's domestic stock fund. Then you have the S and the I funds. Yeah, it's the stock funds. It's important to know that these 3 funds, the CS and I fund, they should be used consistently if you want growth from the stock market. In other words, when the market might be falling, you shouldn't be running away from the CS and I funds. If you're really close to retirement, at least with your allocation every 2 weeks, you might want to consider continuing to buy those funds.
Okay, so if I'm understanding you right, prices going down, we want to buy at that point, correct? The old adage.
True. You want to buy at that point, but we're not talking about your balance.
Okay. And so as I near retirement, I feel I might have cut you off a little bit. You were about to talk that if I'm nearer to retirement, what else do I have to consider?
You mean when the stock market's falling?
Yes.
Well, you should utilize dollar cost averaging. Every 2 weeks, you can buy per pay period as the stock market is falling.
So that's right, Charles. So what we're saying is we buy on sale, right? Kind of like you would as soon as things go on, Memorial Day sale, Labor Day sale, you want to take the opportunity at that time.
Exactly, Mark. Who wants to pay list, right? We've said this on a number of occasions. Why would you pay full price when you don't have to? Now, when you get towards retirement, within 3.5 years, that's when it might be time to start pulling back from the CS&I funds and start to consider how much you'd need for income. Could you handle that risk now? A lot of folks, they're ready to retire. They've reached that point where they wanted to have a certain amount in their TSP. And then just before they go to retire, the stock market pulls back again and they go, oh, boy, I'm not sure I can I can handle it now.
Okay. So maybe we can delve into that a little bit more. If you're close to retirement, right, and you've lost a little bit, if you're close to retirement, why is that a concern?
Great question, Mark. And if you've lost a percentage, let's say a modest, maybe 5%,
Mhm.
it would be challenging to make that loss up if you're pulling money out for income.
All right. So then taking it from there, you said earlier there's only 5 funds to choose from, but I see that the TSP lists at least 10. What are those? What's the difference there?
You're talking about the ELF funds. Yeah, so there are 10 ELF funds listed in addition to the 5 funds. It's important to realize the ELF funds at TSP are, in fact, just a mixture of the other 5 funds. And to clarify, for non-federal employees who may be listening, or spouses or family members of federal employees, in a 401k, they're not called ELF funds at all. They're called target funds. So there's this year that's chosen that you want to retire. And so when you get towards that year that you want to retire, then it becomes more and more stable, let's say. In a 401k, maybe more into more fixed income you'll see there, or maybe even a money market. But at the TSP, the only fund, again, that's guaranteed not to lose money is the G fund. So it becomes a lot more heavy as you get to that exact life cycle year, or at a 401k, a target year, and it becomes more stable, right? It becomes a lot more money in that G fund more than anything else. I mean, as we look right now and record the L Income Fund, that's the one where you say I'm ultra conservative. It's about 68% G fund. So you can see how conservative it is. But the returns from the US Treasury securities, that's those that are issued there by the government, that's what's backing that up, right? Is guaranteed by the US government. But the returns, again, we've said, could be modest.
All right. It makes sense, right? You're getting less, but you're getting more security, as it were. You have that security blanket. And you be a G man without having to wear the fedora and the gray suit, unless that's your thing, in which case, by all means, feel free. All right. So refocusing then on the 5 funds, how can I start using those 5 funds better as I near retirement?
Well, perhaps as you get maybe, let's say, within 7 years from retirement. I know I said 3.5 years, but now that you know you're inside the last decade of your working years, you might want to slowly introduce gradually the G fund, the F fund, more conservative funding into your TSP. What seems to make sense, though, is to continue to buy future contributions every 2 weeks. We're not talking about your big old balance, but every
Right.
2 weeks, continuing to buy the C, the S, and the I funds. And
Okay.
perhaps
So
maybe, yeah, that's right. Perhaps in January every year, or December with your downtime between holidays, if you've got such a thing, then a lot of federal employees have use or lose time. So they do have vacation days then. You might want to go ahead and rebalance your balance of your TSP,
right.
especially as you get closer to your retirement date.
Fair enough. And every 2 weeks, you said that. So why is it important to be buying the CS and I funds every 2 weeks?
Well, that's your future contributions. And so, because it's a much smaller amount, let's say you've got $1 million at your TSP and you're putting in $1,150 a pay period. Well, $1,150 compared to $1 million, that's not going to rock your world if that $1,150 falls. But what you're doing, and we talked about this on other episodes as well, is you're introducing dollar cost averaging. So if the stock market is falling, every 2 weeks, you're buying like a sale again. And so all along the way, you're buying at those increments. So that's
Okay.
why they call it dollar cost averaging. In the end, that average is going to really be dynamic for you and your balance over time. So that's why it's a concern when folks completely yank their money out of the equity funds, the stock funds, the CSI funds. Early in your career, you got to go hard if you want to make any money. Pedal to the metal all in, right, on the C and the S funds. But as you get closer to retirement, then maybe you're easing off the gas, right? I know in my Tesla, I don't even have to hit the brake. If I just get off the gas, it has regenerative braking inside of it. It's built in. So you just start easing off the gas, and maybe you start weaving into your tapestry some G and F money here.
Okay. All right. And by the way, you're not easing off the gas in your Tesla, are you? I think Mr. Musk might have something to say about that.
That's right. We don't call it the accelerator, don't we? Yeah.
Yeah, it's something. Give it the juice. You can use the word juice. The juice. Anyway, getting back to what we're talking about. Okay, so we're discussing investing early, going hard early, and then maybe reeling it back. Now, I've heard of the 60-40 investment plan, right? You know what I'm talking about there.
Oh, yeah.
60% stocks, 40% in stable investments. Is that good? Is it good to think of it in those terms?
I'll tell you stories so we can get a concept of this. 60-40 plan means typically that 60% of your money, always go risk to my right, 60% of your money is in stocks, and then 40% of your money is in what we consider stable, quote unquote. But my dad's approach to the stock market in his time, right, leading up to the change of the millennial, especially from 1992 to 1999 stocks, your barber could give you a stock tip, and everything just soared, right, in those years. But what else was happening is that from the 1980s, I don't know if you remember, Marcus, but in the 80s, I was saving even in high school. I had a CD right out of high school. You want to guess what my interest rate was?
I don't even want to think about it. It's been a long time ago. I was a wee lad in the 80s, by the way, so. I graduated high school in the 80s. I can't claim that, unfortunately. Go ahead. I'm sorry. Go ahead. What was it?
I was getting 10%.
Wow.
From a CD. Yeah. So I felt like I was King Kong. I was doing the right thing, right? But slowly from the 1980s, things, and then maybe not in a straight line either, of course. And this is a little oversimplified, but for illustrative purposes, illustrations, that interest rates were falling. So when interest rates, here I'll show you like this, when interest rates come down, bond funds go up. Yeah. And so, Mark, tell me the name of a big stable company that you like, and we could use that as a basis for the story about bond funds and interest rates.
Well, I guess, if you're talking about big stable companies, especially where I live 10 minutes from Dell's headquarters, I would probably automatically think about them, just as an example.
Okay, great. So you've got Dell, big stable company. Now, as interest rates rise, instead of bond funds, when interest rates drop going like this, like in my dad's stock market, interest rates consistently kind of went down over the next 15 years up to the millennial, till 2000. So if interest rates rise, bond funds do this. I'm going to explain it to you this way. Let's say 2022, Dell offered a fixed rate of interest on a bond. You bought a $10,000 bond, Mark. You bought a $10,000 bond, and it paid you 3%, Marcus, because interest rates are at the bottom. Okay?
Yeah.
How's that sound? So every year it would pay you $300. Typically, a bond twice a year will pay you. Okay? That par rate. So you make your 3%. And you figure it's Dell. At the end of 10 years, 2032, guess what? You get your $10,000 back. Okay? Now, let's say I come along with interest rates going really up 2 years later, and I can even buy a Dell bond. Let's say I do. And I buy another $10,000 bond, but now interest rates are soaring. And I buy it for, let's say, 5 or 6%. Okay? Let's say you get a 5% bond. Now I'm going to get that for 10 years. You turn around and your friends tell you at work, hey, Marcus, what are you doing? The stock market's rolling. Get rid of that bond and get out here in the stock market with us. Let's go ahead and buy the S&P 500, the C fund, right? Or kind of the smaller stock fund, the S fund at TSP. And you go, okay, that sounds like a good idea. I'm going to do it. And you turn around and you want to sell that bond. Well, if I'm getting 5% And Marcus, you're getting 3%.
Yeah.
Do I want your 3% when I can score 5%?
I wouldn't. Basic math, right?
Basic math. So, but you say, no, Charles, I really want to get out of this. Come on, help me out. And so you say, come on, Chuck D, roll it for me.
Come on, Chuck. Hook a brother up.
Hook a brother up, right. So I say, okay, listen, Marcus, you know I love you like my brother. You are my brother. So 3%? $10,000? Marcus, why don't you just hold it? If you hold it, you're going to get your 10 grand back at the end of this term. You say, no, that's not what I want to do. I already told you. I want to get out there in the stock market. And I go, well, okay, I tell you what, I'll give you 9 grand for that $10,000 bond. And you say, what? I thought we were friends. We've been through stuff together. And I say, look, Marcus, I can't help you. Nobody wants that bond. The only way I can make this equitable for us both is I'm gonna buy that bond at a discount to par value. And so I buy it at a discount. Nobody's happy. You're not happy. And what did you do wrong, Marcus? You bought when interest rates were here, and interest rates just happened to go up.
Yeah.
So now as interest rates rise, bond funds can lose because the bond funds don't have any choice. When people sell the position to get back into the market, they have to sell bonds that they've already bought in the portfolio that are at a lower interest rate and buy at a higher one. But when they sell off the lower ones, they have to sell at a discount to par. So guess what happens when interest rates rise? Bond funds lose. How's that?
Well, that makes sense. So then it takes me back to the original thought of just maintaining something stable. Why couldn't you just be all stable? What's the issue or problem with that?
You can see one of the problems with that is fluctuating interest rates. And even if you don't have that problem, because we did say the G fund states that you cannot lose your principal, right? Yep. So the government's backing that with their treasuries. But you're also going to have that issue of deflation possibly because you're not pacing or outpacing inflation. And that is actually the goal of the G fund. It says to outpace inflation without exposing the fund to risk of loss. So it's not really been accomplishing that, especially in this higher inflationary environment. So, but you asked that question, why can't you just be all in safety? Well, we talked about inflation. Secondly, all in one solution, it's usually not a balanced approach.
Right. It reminds me of the friend of yours. You told me a story about a guy who was digging the carrots, right? Like that, like he felt maybe that was a long-term solution to a lot of health problems. What happened with that guy?
Well, we were young guys, Darren. I can still see him. And he was on this kick, man. He was on, like, say, 10 days of this carrot juice. And you know what happened to his complexion, right? This is before we had yellow and purple carrots, right? They were orange. You know what happened to his complexion and his palm? What the color was?
Orange.
We said, whoa, Darren, stop with the carrot juice. It's too much of one thing. Just too much, yeah.
That makes sense.
Do you remember that house? Do you remember the house we had in Florida?
Yep. Yeah.
Those nice garden boxes?
Yes, absolutely.
Yeah. They were cool. I mean, it was a cool house in Florida Park, really close to the Circle in Orange, if you've ever been there, any of you listening. So we had these, like, I call them Napa-style garden boxes that come up to, like, your hip. Oh, not that high. I'm holding my thigh when I say hip. They come up to like your thigh, right? So they're elevated. Well, this couple that sold to us apparently planted a bunch of crops and they went through a pretty sudden divorce. Anyway, this kale started coming up and kale was great, right? I mean, we had it in our breakfast shakes. I knew it was good for you. I started learning how to fry it with my eggs in the morning. Angie would make kale chips. Can you think of any other uses for kale, Mark?
Absolutely. It makes great roughage for a salad bar. If you put it around the other stuff at the salad bar, it's a very decorative thing.
Yeah. So you're talking decorative now. Angie was making stir fry. I had a team member that was from Italy, and he showed us how to how to cut the greens and boil them with the actual pasta water and then pull it out. It was great until it wasn't. Yeah. And like 3 weeks later, it was like, enough kale. You know why I'm telling you this? Because, go ahead.
No, I was going to say you lasted a lot longer than I did, but please, I didn't want to interrupt your kale point because you were driving home a good point. I'm sorry.
Yeah. Life is about moderation. So when you get towards retirement, you got to be balanced, right? If you're going to need the money for income, it could be very dangerous to keep everything all in the stock market, the C and the S fund. If you're going to need money for income, it may not be balanced to have all of it in the G fund. In fact, when we talked about the L income fund, the TSP board themselves and whoever's balancing the BlackRock, I believe, that's balancing the Lifecycle funds. Remember, we said it's 68% or so in the G fund. They got another 5.5% or so in the F fund, which is still exposed to interest rate risk, but they have it there. And they've got what? Well over 25% in stock funds. Why? Why do they have that?
Good question.
Because you've got to get some growth. You have to have some growth. So even if you got that in that illustration again, $1 million, if the stock market loses 20% while you're pulling money off, well, if you're in that L income fund, 68% of it isn't going to lose anything, right? So it kind of holds you there. Is that the ultimate solution? I think, again, life is about moderation. So likely there may be things outside of TSP. And we've talked about how your money for income could be separated from your money for growth. So then if the stock market lost on your money for growth, your money for income might be stable and that wouldn't impact you. And so that would be a smart way, an option for you to consider on your TSP, your spouse's 401k. Yeah.
All right. Well, that's a lot to take in. I appreciate you going into that. Now, what if someone would like professional advice on a TSP, on their TSP or their spouse's 401k? Could they reach out to you directly?
Sure. You could actually call our phone number, our 949-359-5100. Click the icon, and there might be a link to our calendar there. The link is right there in the description of our podcast. So you got that too. So you can always reach out to us. We're just a phone call away, and it's up to you to do that. You can click the link to the calendar, or you can call in, and any team member would be happy to help you.
Fantastic. So just putting a little bit of a bow on everything that we've discussed today. We've gone into the 5 funds, right? The TSP, the importance of understanding them, knowing where your money is, where it works for you, correct? We have to have a good game plan. Do not eat all carrots or kale. For the love of God, mix in a steak. You'll be better off for it, and you'll be much happier, at least in my very humble opinion. Charles, I don't know if you have anything else before we put a bow on this episode.
No, you got it, except this guy over there, he loves steaks. He's a red meat eater.
I am in cattle country, firmly entrenched. Yes, I sometimes drive by ranches and take bites right out of the cows just as they're wandering around the grass, man. Good and good for you. So that's my health tip for today. Do you have another health tip you want to share with us?
Not today. I'm going to let it sit there, right, with the macrobiotic diet, with the raw beef, the tartar.
Yes, sir. All right. Well, everybody out there, see Charles for financial advice. For health advice, go buy a cow. You'll be happier for it. Tartar is good for you. I'm Marcus C. That's Chuck D. As always, we thank you for joining us here on the CD Financial Podcast, where health meets wealth. Look forward to seeing you next time. Thanks again. Take care, Chuck.
You too. Remember, you don't need to work longer. You just need a better plan. CD Financial, where health meets wealth.